Hey everybody, let's take a look at another type of adjusting entry, an interest expense. And this idea is that a person needs money. They need access to cash, an upfront lump sum of cash. And on the slide here, we see a little example of a person saying, I need a loan, I need $5,000 cash because I don't have enough in my own bank account. So imagine Natalie getting the loan from her grandmother. Okay, that's the example that we're using in our case study. And then there's someone who's willing to lend. Now, in Natalie's case, it is her grandmother, but this might also be a bank or some other type of lender. So what will happen in this type of a scenario is the money gets lent, the initial $5,000, but also there is going to be an interest component, meaning interest will be charged. And those of you who have a credit card, you're familiar with this idea of interest, an interest rate and interest expense. So it's basically the same concept. We're now looking at it in terms of a business owner getting access to an upfront lump sum of cash. Now, what we need to know, I should note, we're going to focus on interest expense later. What you will be introduced to in this chapter is just the basic understanding of how we compute interest expense. And what it is it's the face value of the note, meaning the face value is the lump sum of cash, in this case, the $5,000, times the annual interest rate, which here is the 12%, times the terms of the year that we're accounting for. Now, what does that mean? Let's unpack that a little bit. If we are booking 1 month of interest expense, then we're going to divide up the annual interest expense into 12 segments or 12 kind of chunks of expense. So $5,000 times 12% gives us our annual or full year interest expense. And then we want to divide that number by 12 to get to a monthly interest expense amount. Okay, that's basically a straightforward calculation. If we look here on the how to account for that, so in this case, let's imagine that she's going to pay her grandmother the $5,000 plus the interest at the very end of the loan term. So what she wants to do, though, or what she must do, is she must capture each month the slice of interest expense or the slice of interest that relates to that month. Okay, this again is the idea of matching our expenses to our revenues. Now she's using the note payable from her grandmother as cash in her business to make revenue. So she must incur this interest expense as part of the matching principle and matching her expenses with her revenues. Okay, here's how we're going to do it. She's going to set up a payable at November 30th for $50 because that's the monthly expense that we computed up here. And she's going to recognize that that's expense, interest expense. She's going to have a journal entry that says interest expense, meaning $50 is going to be debited because that's how we increase or incur an expense. And then the payable is going to be a credit because that we credit to show the increase on liability. Again, if you're a little bit shaky with the debits and credits, just break out those notes. Maybe go back into the book. If you're working in small groups, this maybe is now a time for the researcher on your team to maybe share the screen and you can all revisit the debit credit logic from chapter 2, okay? Finally, the ledger, we wanna go to our interest expense portion of the ledger and book that $50 of interest expense on the debit side, and then we're gonna show the payable as a credit going up, okay? That's interest expense.